In this video, we're going to talk about cash flow budgets. Now, there is a corresponding video where I take a Microsoft Excel spreadsheet with a cash flow budget in it and kind of break all this down for you in a more practical manner. But today I wanted to jump in and do like some formal textbook style definition. Our source material is the Farm Management 9th edition by Key, Edwards, and Duffy. I'll try to give you a link down in the video description to this text. It's a standard textbook for farm management that's used in a lot of universities. So what is a cash flow budget? A cash flow budget is pretty simple. It's a summary of projected cash inflows and outflows for a business in a specific time. And this is really important. I want to hammer on this here. It's a projection, right? You're projecting into the future. It's a prediction, an estimate, just like any budget is. And it has cash inflows and cash outflows, meaning we only look at the cash that's moving in and out of the business. And this is important because there are non-cash inflows and non-cash outflows, non-cash expenses and non-cash sources of income. I'll explain what I mean in just a little bit, and the timing is very important. The time might be the most important part. Essence of the cash flow budget is answering this one question right here. When will I need money? And am I going to have enough money on hand when I need that money? In other words, will I have enough capital on hand when I need it? Capital in this case specifically means cash, money. A lot of times the terminology we use in this context is a bit archaic. Here is a buzzword, anachronism. So an anachronism is a thing belonging or appropriate to a period other than in which it exists, especially a thing that is conspicuously old-fashioned. An anachronism is something that is out of place in time. If you've ever been to a Renaissance fair, that is an anachronism. What do I mean by that? We're not talking about literal cash. We're talking about the amount of money that's in your bank account. At the time I'm recording this, we don't live in a cashless society, but we're getting really close to it. Once upon a time, people cut checks. A check itself, the concept of a checkbook is an anachronism. Now everything is moved electronically. Electronic transfers between banks. Things like Venmo and PayPal and Cash App. There's a thing called ACH that stands for Automatic Clearinghouse. That's what's used for your direct deposit if your job is direct depositing your paycheck. So again, understand that we're not talking about literal cash unless you're Walter White or Saul Goodman or someone like that. The difference between the budgets we've done so far and a cash flow budget, there are two main distinctions. The first one is a cash flow budget is all cash flows and only cash flows. And the second one is timing. So the timing and the actual movement of the money in and out of your bank account as you conduct business. So you've got revenue coming in from things like money that you borrow. Money that you borrow from a bank is cash inflow. Investments that you make inside your business. If you want to start a business up, you've got to get that money from somewhere. Money comes from borrowing and investing. So when you invest in your business, that's a cash flow into the business. When you sell something, you get revenue. That's the purpose of the business, is to earn that revenue. And sometimes you sell one of your assets. Maybe it's an old piece of equipment and you need to upgrade, so you sell the old one. That is a cash inflow. Cash outflows are when you make payments on debt, when you buy inventory. So that's when money is going out. When constructing a cash flow budget, the emphasis is on the cash flows. No matter where the cash comes from, regardless of the source, focus on the movement of the money. And this is kind of the main point I'm trying to get to right here. Depreciation is a non-cash expense. There may be other non-cash expenses, but depreciation as a non-cash expense is the one that jumps out first. When you're doing your budget, when you're doing your taxes, you include depreciation, and depreciation is a type of expense. When I ask students, what is depreciation? My hope is students will answer that depreciation is an expense, and specifically, it is a non-cash expense. A cash flow budget will also include when the cash will be received and paid out, as well as for what and how much. In other words, every line in the budget tells us what we're spending our money on. And we're going to take the lines of our budget and expand it. Instead of the budget for 1 year, now we have a budget for each individual quarter. And the cash flow budget shows when cash is going to come in, when cash is going to come out, and what that cash is used for or where that cash came from. Now, there's an accounting document called a statement of cash flows. And there's a difference between your cash flow budget and your statement of cash flows. The cash flow budget is a projection, a plan, a forecast, an estimate. You're thinking about next fiscal year, next calendar year, and you're looking forward into the future of your business and you're saying, what am I going to spend in January? What am I going to spend in February? What am I going to spend in March? Okay, great. Where's my money going to come from in January and February and March? Whereas a cash flow statement is a financial document that shows a historical account of those cash flows. So the budget looks forward, the statement looks backward. The budget is a planning tool, the statement is an accounting tool. All right, I'm going to give you 3 reasons why you need to track your actual cash flows in your business and include them in your statement of cash flows. So what you've got to do is project your cash flows and then track the cash flows. So your cash flow budget becomes, in essence, the template for your statement of cash flows. Number 1, if you record and summarize cash flows every month, then you can compare cash flows to your budget. Okay, why is that so groundbreaking? This is your early warning system. In January, February, and March, you can look at your planned cash flows, your actual cash flows, and then at the end of the first quarter of the year, if there are red flags, they're going to pop up. All right, number 2, cash flows provide insight into business structures. What do I mean by that? You need to know which actions are making cash, which things that you're doing in your business that create cash, that cause cash to happen, and then which actions cause you to burn cash. And of equal importance, is your cash coming from the right place? If you're taking actions that burn cash, those actions need to be making more cash than they're burning. And again, is the cash coming from the right place? Ideally, your cash comes from the operation of the business. You're selling something for a high enough price, cover your cost, have money left over, and that's where your cash flow comes from. So what you're going to see is this intimate relationship between cash flow and profit. The breakdown is oftentimes timing because you have to burn the cash before you can create the cash. It takes money to make money. You got to spend first. So when you're looking at your cash flow statement, you're looking at how do your operations, your investments, and any borrowing that you do, how do they come together into sources of cash and how is the cash being used? Number 3, it's a starting point for next year. All of your budgets are starting points for next year. Whenever you're building any kind of a budget, not only are you planning for the next fiscal year, you're also laying down a foundation to plan for the next fiscal year. Let's talk structure of a cash flow budget. First thing you need sources of cash, right? Where does your cash come from? And so the top of a cash flow budget is always going to show your beginning cash. This is the amount of money you have in your bank account or that you project to have in your bank account at the beginning of the time period, whether it's a quarter or a month. In essence, is nothing more than the cash you had on hand at the end of the last time period. So you're basically going to bring that balance forward. Then you have cash sales. This is your operating revenue. This is where money is flowing in from running the business. So sale of capital assets, that's where you have some piece of equipment that you are selling. And if you sell that piece of equipment, that means cash is flowing in. So that goes down as a source of cash. Now on this slide in front of you right here, these first 3 bullet points, these are things that are all going to be on the top of your cash flow budget. The 2 things in red are going to be at the bottom of the cash flow budget. I'm going to show you that in just a second and talk in more detail about what goes on at the bottom of the cash flow budget. Those 2 items, non-business cash receipts and new borrowed capital. I take a little bit of issue with the wording that my source material uses. Non-business cash receipts, what does that mean? Better way to think about that is cash into the business, where you take cash from your personal life, your personal household, your own personal checking account, and move it to your business checking account because you have 2 separate accounts for these things. You don't intermingle the funds between your business and your personal life. And the non-business cash inflow goes at the bottom of the cash flow statement. In new borrowed capital, I prefer new borrowed cash. The book seems to be using the word capital and the word cash interchangeably. So we're talking about cash. This is money that you have borrowed. And specifically that new borrowed capital and that non-business cash receipts, that's money that you're bringing into the business to cover a gap in your cash flow. So in a perfect world, you've got enough cash sales to handle your cash flow, but sometimes you don't. And those 2 things at the bottom are of key importance. The reason you do a cash flow budget is so that you can plan for when you need to find a different way to bring the cash into the business in order to meet your needs. Those are the sources of cash. Okay, uses of cash, operating expenses. All right, obviously anything you spend money on, to buy inventory, to keep the lights on, to feed the animals if it's a farm, These kind of things. Capital purchases. If you buy equipment, that's cash flowing out of the business. The two things in red, non-business expenses and debt repayments, are cash outflows. And again, I kind of take issue with the wording. I think the wording of non-business expenses out of this textbook is because oftentimes farms do indeed intermingle their household expenses with their farm business expenses. But the way you want to think about that is if you have a non-business expense, a personal expense, you need to pull the money out of your business account and move that money to your personal account and then make the payment. So the two things in red are cash going out of the business, right? When you repay debt, that's cash going out of the business. It's money you don't have to spend. It's a cash outflow. A good cash flow budget requires a ton of data, especially if you are looking at, say, a whole farm cash flow budget or any business where you've got multiple enterprises going on. So I tell you this so that you will remember that if you're going to sit down and do some cash flow planning for your business, putting together a good cash flow budget is going to be difficult. It's going to take a lot of time, and it's got to do a couple of years really to get it down to a science where it's operating smoothly. What I want you to remember about the cash flow budget is it is a decision tool. It's there to help you understand when you need to borrow money. Your business has to cash flow, meaning you have to have enough money on hand to cover expenses. And if you don't have enough money on hand to cover expenses, you got to borrow that money or bring money into the business. The cash flow budget also gives you a clue as to when you can take your profit from the business and take it into your household to cover your household expenses. Okay, the organization of the cash flow budget, you always start with a beginning balance, and then you add cash in from operations and the sale of capital assets, and then you subtract your cash operating expenses. Some businesses have a thing called accounts receivables. Accounts receivables is just basically where you've sold an item on credit. You've already delivered the item to somebody and they haven't paid you yet for it. Accounts receivables is an asset, but accounts receivables is not a cash flow. Let me clarify that. The accounts receivables this month are not a cash flow, but the ones from last month should flow into this month. So be very careful when looking at accounts receivables. The most important part of the cash flow budget is at the bottom. The bottom of the cash flow budget is a worksheet that you use for cash flow planning. Here is a cash flow budget for a backyard chicken operation that sells eggs, like at a farmer's market. And down at the bottom, we have our cash transfers, our cash in, our cash out, additional borrowing, additional repayments. And here's the question for you. Did this business do a good job planning cash flow? You might look at it and say, well, they didn't run out of cash, so they must have done a good job planning cash flow. I'm going to look at it and say, no, they didn't. They did a bad job planning cash flow because they didn't plan their cash flow. There's zero cash flow planning. Let me show you what I mean. This business is planning on having $1,287.50 in the account at the end of the first quarter. Why? Why? Here's an idea. Let's take $1,000 and let's bring it home. Now your business has made you $1,000 that you can take into your household and cover your personal expenses. And you're going to end up with $287.50 left over. That $287.50 then becomes the beginning cash the next time period. And at the end of that time period, you're expecting to have $600 and some change. Why do you need it there? It's not earning you any interest, perhaps. Maybe you want to take that money and you want to move 400 of it out and put it into an account that's going to bear some interest, or put it into some other investment, or maybe you need to buy your kids some shoes. So you got to pull it out. And because you're doing your cash flow budget, you know you've got the money there to pull it out if you need to buy your kids some shoes. The bottom is a decision worksheet. It's what you use to ask if you have enough money this month or this quarter. And if you have plenty, you have to ask yourself the question, what's the best use of the extra cash that I have? And if you don't have enough, if you end up with a negative ending cash, you've got to ask the question, how am I going to cover that hole? There's two ways to cover the hole. You either borrow money or you invest money in the business. Transfer money from your personal bank account to your business bank account. That's what you do. All right, back to the budget, the cash flow planning. It's not good cash flow planning. Let's move $700 out. Then let's move $1,000 out. And now we've planned out our cash flow. And we've, over the course of time, been able to bring money into our household to put it into different or better investments, or just spend it. That's why you make money, to spend. It's there to spend. So the bottom of the budget is a worksheet. That's the important part. If I ask you to plan your cash flow, I'm asking you to go to the bottom of this budget and find out if you have enough money at the end of the quarter, or if you have enough money to cover your expenses that quarter. What are you going to do if you have extra money? What are you going to do if you don't have enough? That's what it's there for. It's a planning tool. I'll catch you on the next one.